Welcome to Breaking News to Trading Moves. We are looking squarely at the headline event that has the market adjusting right now. We are calling it the tariff pivot.
Yeah, it is definitely the central theme today. We have seen a specific sequence of legal and administrative moves that changes the calculus for importers and domestic producers alike.
So let's get right to the facts for you listening. The catalyst here was the U.S. Supreme Court. They struck down the tariffs that had been imposed under IEEPA.
Right, which stands for the International Emergency Economic Powers Act.
Exactly. So the court basically invalidated the use of IEEPA for those specific broad tariffs.
They did, but the administration's response was it was immediate. They didn't step back at all. They pivoted.
They moved to an entirely different legal authority.
Section 122 of the Trade Act of 1974.
And this is not just some legal footnote. It changes the actual mechanics of how these duties are applied. We're looking at a temporary, across-the-board import surcharge.
The structure is very specific. It starts at 10%, and the plan is to raise it to 15%. But there is a time component here that investors are watching closely.
The clock is ticking.
Right. Section 122 comes with a clock. There's a 150-day window. Unless Congress steps in to extend or change it, that is the time frame we are operating within.
That creates a very specific environment. The market mood right now is being described as policy uncertainty mode.
Yeah, it feels like everyone is trying to figure out the new rules of the road in real time.
When you look at what investors are actually juggling, there are three moving parts to this. First, you have that new temporary tariff rate.
The 10% moving to 15%.
Right. Second, there's the question of what happens next. Is there a path to more targeted permanent tariffs after this temporary window closes?
And third, and this is crucial for corporate balance sheets, is the question of refunds.
Will companies actually get money back for tariffs they already paid under the previous IEEPA framework?
And if so, when? That refund question is incredibly complex.
Which leads us directly to why markets care. This is not just about politics, it is about earnings risk.
Let's break that down. Think about import-heavy companies. They are facing potential margin pressure right now because their costs just went up.
But they also face messy accounting, right?
Absolutely. If the rules keep changing or if the refund process takes a long time, you could see very uneven performance from quarter to quarter.
One quarter might look terrible due to the added costs.
And the next might look inflated due to a sudden refund. It makes it really hard to value these companies right now.
And then there's the inflation angle.
Tariffs act like a tax on goods. That is the basic economic reality. When you impose a surcharge on imports, you are adding cost to the overall system.
Which complicates the inflation path.
Right. If inflation stays stickier because of these surcharges, it changes the expectations for rate cuts from the Federal Reserve.
So it creates a headwind for the broader macro narrative. And I assume this affects where money is flowing, what is the risk appetite looking like?
When policy gets unpredictable, money tends to lean defensive. Investors look for safety.
So we are seeing flows into the U.S. dollar.
The dollar, gold, and consumer staples. The money is moving away from high beta areas, things that are more volatile.
Like crypto.
Yeah, we have seen weakness in Bitcoin recently, while gold prices have been firmer. That is a classic risk-off signal in response to policy uncertainty.
Okay, so that is the landscape. Now, I want to get into the specific winners and losers, because in a setup like this, there are always sectors that benefit and sectors that get squeezed.
There always are.
Let's start with the winners. You identify domestic metals and materials.
This is a textbook reaction. When you have a broad import surcharge, it raises the relative price of imported inputs.
If foreign steel or aluminum becomes 10% or 15% more expensive,
U.S.-based producers suddenly have much more pricing power. They can price their goods just below the import cost and still expand their margins.
it also supports that buy domestic procurement trend.
Exactly. Procurement managers will look locally just to avoid the volatility and the extra cost of imports.
So who are the names to watch here? Let's give you some specifics.
In the steel space, you have Nucor. The ticker is NUE. They are a massive domestic producer. Then you have Steel Dynamics. The ticker there is STLD.
Got it. And for aluminum?
Looking at aluminum, you have Alcoa, ticker AA. These companies are well positioned to benefit when their foreign competitors face a surcharge.
NUE, STLD, and AA. Moving on, there is another group of winners you labeled as U.S. industrial onshoring and electrification.
This is more the longer-term play. If companies believe these costs are here to stay, or if they just get tired of the uncertainty, they respond by localizing production.
They redesign supply chains to be closer to home.
Right. But labor in the U.S. is expensive, so how do you offset that?
You automate.
Precisely. You invest in factory automation and industrial upgrades. This pulls forward investment for companies that provide those tools.
But which companies are we looking at here?
Two names stand out in the data. First is Eaton, ticker ETN.
ETN.
They are major players in power management and industrial upgrades. If you are building a new factory or upgrading a grid, you need Eaton.
And the second?
The second is Rockwell Automation, ticker ROK. They are the pure play on factory automation.
ETN and ROK, this makes total sense. If you cannot import cheap parts, you build a robot to make them here.
That is the exact logic.
Now, you mentioned gold earlier as a defensive play. Let's talk about the gold miners. Why are they in the winner column?
It comes back to that uncertainty we talked about. When the market is fixated on policy risk and on currency fluctuations, volatility expectations go up.
Investors want hedges.
And gold is the traditional hedge. If the price of gold is firming up, the miners who pull it out of the ground tend to benefit directly.
Who are the big players here for our listeners to track?
We are looking at the majors. Newmont is one, ticker NEM.
NEM.
And Barrick Gold. The ticker for them is quite easy to remember. It is simply GOLD.
NEM and GOLD. Okay, so those are the areas seeing a tailwind. Domestic metals, industrial automation, and gold miners.
Now we have to look at the other side.
Right, we have to flip the coin. Who is taking it on the chin? Let's talk about the losers.
The most immediate pressure is on import-heavy retailers and apparel companies.
Because they bring in so much of their inventory from overseas.
Right, and they operate on tight margins to begin with. When a 10% or 15% surcharge hits, they have a really difficult choice to make.
Do they try to pass that cost on to the customer?
That is the exact problem. We call it demand elasticity.
Right.
In discretionary categories, things people want but don't strictly need, there's a limit to how much you can raise prices before people just stop buying.
So they might have to eat the cost, which directly hurts earnings.
Exactly. The names that come up here are the giants with global sourcing networks. Walmart, ticker WMT.
WMT.
Target, ticker TGT. And in apparel, Nike, ticker NKE.
So WMT, TGT, and NKE. These companies are heavily exposed to cross-border trade flows.
They are.
I can see how that 150-day window makes planning an absolute nightmare for them.
It creates a massive amount of noise in their forward guidance.
Another group you highlighted is consumer electronics and hardware. Why is this different from general retail?
It comes down to the complexity of the bill of materials.
Okay, explain that.
A laptop or a smartphone isn't just one thing. It's an assembly of hundreds of components sourced from all over the world.
So hedging against a broad tariff is much harder for them.
Much harder. Sudden tariff changes are very difficult to hedge against when your supply chain is that fragmented.
Because the rules apply differently to different parts.
Right. And frequent rule changes create risks for inventory planning, product launch timing, and pricing strategy.
Which names are in the crosshairs here?
The big hardware players. Apple, ticker AAPL.
APL.
And HP, ticker HPQ. They rely on complex global supply chains that are very hard to reconfigure overnight.
AAPL and HPQ. That brings us to the third group of losers, autos and mobility.
This is a sector where supply chains are deeply integrated across borders.
Parts cross borders multiple times before a car is finished.
Right, so a broad tariff hits them at multiple points in the production process.
It raises component costs broadly.
And again, it pressures affordability.
Yeah.
The original equipment manufacturers face that same dilemma as the retailers.
Absorb the costs and hurt margins.
Or raise prices and risk demand destruction.
If cars get too expensive, people just hold on to their old ones longer.
Exactly. The stocks to watch here are the big U.S. automakers. General Motors, ticker GM, and Ford, ticker F.
GM and F, they are heavily exposed to this dynamic.
Very exposed.
So we have a clear picture of the board now. Domestic producers and defensive plays are looking stronger, while importers and complex supply chains are vulnerable.
That is the current setup.
But markets move fast. What is the trading lens for this week? What should you be watching?
There are two main things. First, pay close attention to retail guidance. We are in earnings season, or catching the tail end of it. You want to look for explicit tariff headwind language in their reports.
You mean, are they actually saying it's hurting them?
Yes. Are they raising prices? Are they moving sourcing? Or are they eating the costs? The companies will tell us how real the pain is.
And the second thing to watch?
Policy clarity. We need to watch for official statements.
To see if 15% is the ceiling.
Right. Will they target specific product categories next? And practically, how will that refund mechanism work? The market hates the unknown.
Any answer to those questions will move prices.
It really is a wait-and-see game on the specifics. Until the tariff framework stabilizes, we should expect choppy rotations.
Choppy rotations. That feels like the phrase of the week.
It is a classic headline-to-positioning setup. Traders will treat clarity, or the lack of it, as the primary catalyst.
Import-exposed names will trade like risk assets.
And domestic producers will act as shelter.
It sounds like volatility is the only guarantee right now.
That is usually the case when policy is in flux.
Well, that wraps up our look at the tariff pivot. We've covered the move from IEEPA to Section 122, the surcharge mechanics, and the key winners and losers in the market.
Just remember, keep an eye on that 150-day clock. That is the timeline that matters for all of these companies.
It really is. Now, here's a final thought for you to explore on your own. If the 150-day window expires without Congress acting, what happens to the billions collected in the meantime? It is an accounting question that could drive the next major earnings season.
That is a very compelling angle to watch.
Absolutely. Before we sign off, a quick reminder. This discussion is purely the opinion of the author and speakers. It is not financial advice, and these are not buy or sell recommendations. Please do your own research.
Always do your own research.
Thanks for joining us on Breaking News to Trading Moves. We will catch you next time.